Well, hello and welcome to another one of our Evolve Alliance showcase videos. Today I have with me Paul Carrington from Investsense, and you are about to hear some great detail about a fantastic portfolio management solution, a way for you to manage your clients' money that will bring extra efficiencies and extra value to your clients. So Paul, welcome to the Evolve Alliance.
Thank you very much. And can I say, Investsense is delighted to be part of the group and to service members as best we can.
Love having you here. Now, let's get stuck straight into it, Paul. We know that there are a plethora of solutions out there for advisors to choose from in the way that they manage their money. And as most people know, our philosophy around this is that it's about designing a philosophy that works for the firm, for the style of clients that they want to work with. Don't try to pitch your value proposition purely being the investment manager, because most of our members and clients are financial advisors. Investment is just one of the things that they do for clients. But it's a really complicated market. There are so many different ways that advisors can approach this. The one thing that we do say consistently is decide upon a methodology that is efficient, that you can deliver well, that you can live up to the promises that you're making to your clients. And nowadays, if they haven't revisited this structure in at least 5 years, it's really well worth putting on their agenda, because there are so many different techniques and uses out there for people to leverage nowadays. So tell me about Investsense. How do you make this easier for advisors and their clients? What do you do?
So, look, fundamentally, we're a boutique investment firm, and we run managed accounts, and specifically separately managed accounts, or SMAs, across numerous different platforms. I think some of the points that you make are really valid, and if you don't mind, I might just touch on a little bit of the history of Investsense and why we actually got into this part of the business. And I'm not going to labour the point or go on too much, but what I will say is the three founders of the firm came from Van Eyck Research. Many of the members will be familiar with Van Eyck, and they were obviously very good in their time. The guys who started Investsense were consultants, senior consultants there, and specifically were working in the retail industry and the retail advisor. So they weren't in the institutional side, they were on the retail side. And they were commissioned in 2012, so some time ago, 10 years, commissioned to establish what would be arguably one of the first managed account solutions for a large licensee. And they did this in 2012. And what came out of it was the guys really thought, this is the future. This makes absolute sense for advice firms. We should be doing more of this. And so they spoke at the time to their bosses, who said, no, we're going to create our own I think their own multi-manager solution, and didn't really want to go down the track of managed accounts. So the guys with this high conviction decided that they'd actually leave the firm and establish Investsense, specifically to be in this space. So there's a huge amount of passion in Investsense, in our firm, that managed accounts are an incredibly good solution for many reasons. So let me touch on a few of those reasons, if that's okay.
Yeah, please.
The first one is, and I think it sort of typifies what we do specifically, is that we utilise in our portfolios direct equities, managed funds, and ETFs. And within the various strategies and sectors, we will normally have some active and passive management. And you could argue and say, geez, that sounds like you're pretty much trying to just cover all bases. The beauty of it is that we actually don't come at this with any biases. We're not a firm that started as a stockbroking firm, hence the SMAs are full of only direct equities. We're not a firm that came from just a manager research background where all of the holdings are all managed funds. We literally come at this as an open book utilising all the tools available to solve the problem for end investors, being your members' clients. So fundamentally, I think that's probably key to us, key to what makes us a little bit different to others in the market.
Great. Now, we're not going to go into the difference between an SMA and an IMA and an MDA today, but needless to say, it probably was a bit disappointing for your founders that Australian advisors or the Australian market took so long to catch on to the power of managed accounts. They've been massive in the US, as we know, for such a long time, but I do definitely see now more and more conversations that we're having with advisors, really understanding actually we're having massive flows into managed accounts now because people have seen that this is most definitely the way of the future and a better way to manage money. And I think one of the elements, which we'll probably touch on a little bit later, is around how do you create this sustainable model, particularly for firms that have multiple advisors. And it's something that we see as business coaches all the time, that as a firm starts to grow, everybody has their own way of managing money, and they might have model portfolios, but arguably if there's rebalancing required, portfolios end up all over the place. But everybody has a slightly different way of doing things. And when you're running a firm that has really more than one advisor, it's incredibly important to have this philosophy for the firm and then choose the right managers or providers that will deliver to that philosophy. So we're going to go into a little bit more detail a little bit later on that. But what we might do now is flick over to one of the advisors. As is customary in our showcase videos, we always like to bring in at least one of your advisor testimonials, because for those who aren't aware, part of the requirements in order for us to accept a provider member into the Evolve Alliance portal is we have to have social proof. We need to speak to at least 2 advice firms who have already been using this provider in their business and can attest to their quality. It's not just the provider telling us how great they are. So let's flick over to one of your advisors right now and hear from them.
My name's Ian Hayes. My business is Milestone Financial Services. Our office is based in Canberra, but our clients are spread out throughout the country now. We have 4 advisors and an AMC and about 15 staff altogether. We have a very diverse client base. We probably focus on wealth accumulators as most people do, but also have a growing number of retirees as well. We have our advisors have different ages, and so our clients have quite a wide range of ages as well. So we first started using Investsense about 12 months ago. We were looking to add some more structure and rigor to our internal investment committee. And we were also looking to launch a private label SMA. And they were the external investment manager we decided to partner with on that project. So it's early days because we're having to give them advice. But I think the conversations we're having with clients is around the speed with which we can make investment changes that we feel are necessary compared to the sort of model portfolios that we had before, and also the sort of the structure of actually making decisions is so much stronger than it was before. We had capable people on the investment committee, but it feels like it was more about individual opinions rather than now Investsense are bringing analysis to the committee, and decisions are being made on the basis of the analysis that they've done rather than just sort of opinions that individuals might have. And that they haven't looked to impose their views on the investment committee. And one of the reasons we selected Investsense from the sort of the shortlist we had is that we felt a real alignment in terms of principles, and they were very keen to build on what we already had rather than sort of start from scratch. And so that alignment of principles and values has definitely been confirmed in the past 12 months as well. So they've fitted into what we already were doing very naturally, and as I say, they've not imposed themselves. And I think that has really just evolved what we're already doing and made it better rather than sort of started from scratch. I would recommend Investsense. It's relatively early days in our relationship, but everything that they told us to expect as far as the relationship with them has certainly happened in the first 12 months. You know, I'm very confident about working with them for many years to come.
So, Paul, that sounds fantastic from an advisor that's already using you. But if I'm a member that's really just coming from the point of, I'm not happy with the way we're managing our portfolios at the moment, I'm looking for a better solution, what does Investsense do?
So we've basically got a number of Investsense branded multi-asset SMAs that sit on multiple platforms, right? Now, they are, I hate this term, Sue, but they're basically off the shelf. So if an advisor is looking for a solution, a fully diversified managed account solution that's, you know, well priced and well put together, then they could literally choose us on Macquarie, Panorama, Netwealth, Hub24, Praemium, AMP North. And literally it's almost like, you know, tick the box, I'll go into that particular portfolio for the client, matching the risk profile.
Yeah.
The other part of the business that we've got is our bespoke part of the business. Now, this is where we sit down with a firm. These are generally larger firms that might have 150 to $700 million, for instance, assets under management, and they would like their own solution. What we would do.
So are these typically firms that also have some people within the firm who have a significant level of knowledge that they want to impart in it, or is it purely a branding thing? So are they collaborating with you in terms of the investment committee, or is it just a branded thing?
It's both.
Either, okay.
We currently have 13 bespoke clients, which doesn't sound like much, but when you're offering a truly bespoke service, you can't do a purely bespoke service to 100 clients, right?
No,
you just can't. It ends up looking very similar. Ours don't, right? So they're very, very bespoke. So 13 clients at the moment. I would say majority of them do have an interest in it, but they can't necessarily either afford a CFA that they've got to pay, you know, 250 grand a year to. There's a lot of cost, there's a lot of risk associated. The other thing that is important to mention is that the platform ultimately would like a professional investment house, a consultant like Investsense, to partner with an advice firm before they would allow those portfolios to go onto the platform, to actually sit on the platform. So there's a few elements as to sort of why it's important to actually have a professional firm like us involved. Majority of them, definitely, there'd be an investment committee, and you'd have, you know, a few from the firm sit on that, a few from Investsense sit on that. We come together and we literally build something out that is going to be perfect for that particular firm. We do have a couple of clients where it probably is about the branding, and it probably is about the desire, the value proposition of the firm to be seen that, you know, we've got this solution in-house.
Right.
That's perfectly fine. Like, we'll work with both, but probably the majority actually do have a keen interest in having a say in how the portfolios are structured.
Excellent. And does that cost them more, or is it purely as a volume-based?
It doesn't cost any more. So, the basically our fee that sits inside the managed account is exactly the same, whether it's an Investsense portfolio off the shelf or whether it's a bespoke portfolio built for a client.
Right, but that's why you have those minimum levels of fund, because obviously under a certain amount it wouldn't be worth your while to take.
Yeah, look, both from our perspective and I think also from the platform's perspective, they ultimately need to see on average a minimum of $20 million per portfolio. to make it viable for really all parties.
Sure. Yeah. Okay. And in terms of the way that you put the portfolios together, you were saying that there's direct equities in there's managed funds and so forth. I know that one of the challenges, we know quite a lot of firms that have had a direct equities offering in the past, and their clients love it because of all of the transparency that comes with direct equities, but it's very clunky and difficult to manage. So if that were the case, would you be looking at their portfolios and then constructing an offering so it's not like they have to sell down all of those shares and then transfer in, or how would that work?
It's a great point. For those that have got direct equities, we've actually built a tool to take their existing portfolios, right? We then do this sort of matching to see what are the common stocks that sit inside our managed accounts. Mm-hmm. And we can then provide a tool to the advice firm to say, these are the common ones, these are the potential CGT implications, mm-hmm. these are the ones you want to in specie across. Right. And if there's some large capital gains on some, then they'd be held outside of the SMA. So, right. Definitely we're here to do the heavy lifting, right? We're here to help the advisor make any kind of transition from what they're currently doing to a managed account as easy as possible.
Great. Now, if they're on the flip side, so if they've never had direct equities, because we know how difficult it can be to manage portfolios of direct equities.
Yeah.
And so if their positioning has always been around managed funds, without detracting from our investment managers that we know and love, what's the benefit of moving out of that pure managed fund environment?
Yeah. Look, I think
other than the whole needing an ROA and the extra
sure.
administration from the advisor's perspective.
Yeah. Look, I think there's a few, and remembering that we do have all of those in the portfolios: managed funds, ETFs, and direct shares. I would argue that the direct equity piece within a managed account or an SMA is incredibly important, and I'd say this for this reason. I think that the direct ownership, the tax consequences of that direct ownership are incredibly beneficial for the investor, first of all. I think that, and remembering that all corporate actions we deal with. Okay, so the advisor is not having to, deal with a buyback or deal with any of those things. Those decisions get made at our level as the portfolio managers, right?
Yeah.
But picture this, and we've had a lot of lockdowns in Melbourne, which is where I'm based. So barbecues have been few and far between more recently. But if you think about your average barbecue conversation, it's, what stocks do you own? Oh, you should have a chat to my broker, she's fantastic and I've done really well and whatever. There is definitely an element of excitement and interest and engagement when you're talking about direct shares, right?
Yeah.
So I think that the managed account, because of that direct share ownership, provides another level of interest, another level of engagement between the investor and the advisor.
Yeah.
Now, we have something called a chain of understanding within Investsense, which basically means everything that we do in the portfolios needs to be articulated to the advisor in a way they can articulate it to their client. So we've built a thing called it's called an advisor portal. It's password protected. Every time we make a change to a portfolio, as the change is being made, an email goes to the advisor. It'll have a PDF attached, which says, we've sold BHP, we've bought Rio, this is why we sold BHP, this is why we bought Rio. The advisor can send that to their client, okay? And just say, dear Tom and Mary, just letting you know of a recent change to your portfolio. no ROA, no SOA, a fantastic engagement tool.
Yeah.
And all that's happened is the advisor's got to send an email to those clients.
Right.
So
it's not the case that now that the client can see what's in their portfolio, they might be picking up the phone and talking more about, oh, I heard something on the news about Coles Myer and I've got it in my portfolio. This kind of solves that engagement without necessarily one-on-one conversations.
It absolutely does. And
right.
The advisor portal was built from feedback from our clients. Everything that sits on the portal has come from our clients saying to us, it'd be really cool if we had this, it'd be really cool if we had that, could you do this, could you do that? It's not there because, you know, we've thought, oh, we think this is a good idea. It's because our clients have requested it. And so it's a very, very valuable tool.
So now, Paul, as you know, a part of our philosophy here at Elixir and at Evolve Alliance is that there's never a single solution for every different business. We're not out here saying every advisor should use one solution for every problem, because we know that advice firms are different and their propositions are different. So as a result, we do have multiple providers that might sit under the same spoke, for example, in the portal. So if firms they've decided that they need to improve the way they manage money, they're coming in, certainly we would suggest that people come into the Evolve Alliance portal to at least create a short list of people to talk to, because there are so many different options. But what makes you stand out from the crowd? Why would somebody do business with Investsense as opposed to any other SMA provider or fund manager?
Yeah, look, it's a great question. If I think about, and maybe the way to position this is, why do clients choose to work with us? Why do clients pick Investsense? So here, you know, this is what our clients tell us, and I would ask, I know there's going to be some testimonials, but I would equally ask, any of your members can contact me and I'll refer them to any of our clients and they can have a conversation, right? There's no one we don't want you to talk to. You can talk to anyone and hopefully they'll all say good things. But if I think about why they choose to work with us, there's probably a few reasons. One of them is because we don't come with biases and we do offer a solution that isn't narrow, that is truly multi-asset and I guess is very transparent and open about sort of what we do and how we do it. And hopefully I've articulated a little bit of that in this session.
Yeah.
The other thing that I do think resonates really well with advisors is that we fundamentally are an SME, right? Now, I'm one of the owners of Investsense, and I've got 3 business partners who are happen to be the founders of Investsense. We are the equity holders. It's our business, and then we've got a number of employees who also work in the business. We treat our clients the same way an advisor would treat their clients. We're available to our clients the same way an advisor is available to their clients. So I think when you're dealing with the business owners and you've got direct access to pretty much everybody at Investsense, there's no layers of, you've got to speak to this person or you've got to speak to that person. Literally, we're all available. I think that's a major differentiator between us and, let's face it, some of our competitors. So you very much get that. The level of transparency, the fact that we exist for the retail advisor to get a better outcome for their clients. That's really our reason for being.
Fantastic. Now, if I were to put my contrary hat on, I might say, well, actually, Paul, that might mean that there's greater risk because you're a small business like mine. And when it comes to managing my clients' money, I can't take any risks. Am I better with a big brand who's got a huge footprint? What would happen if, let's say, heaven forbid, all 4 of you got on the same plane and it went down?
That's a scary thought.
It is a really scary thought.
Even
as I said it, I thought, that's terrible.
Yes. No, look, it's a bit.
Always go on separate planes for a start. But aside
from the fact that we are on different planes, and funnily, if we're in different locations, I'm based in Melbourne. Most of the team are based in in Sydney. Look, I think it's important. I think for any business like ours, where we are the, for want of a better term, but the custodian of assets, so to speak, you've got to have things in place. Disaster plans, all of that, which we have, and as you would expect. I think an important point to make is this. Our portfolios, you don't invest in Investsense directly. You invest via a platform. So our portfolios sit on the platform, and the advisor will choose to invest in them. Now, God forbid we were, the owners were all struck down at the same time. Those investments are still there, sitting on Macquarie or Panorama or what have you. We've got these contingencies that there would be someone else come in to manage the portfolios, but equally, let's assume the advisor got nervous and went, geez, that wasn't good. I really had a lot of faith in those particular guys. Then literally you make a withdrawal, you roll it across to wherever it is that you want to roll it to. So we don't physically hold the assets. The assets are held within the platform as the custodian.
Sure. Yeah, that makes perfect sense.
If I may add just one other thing around our size, and one of the things that advisors say is, well, look, you're not a very large business. What makes you, why should I choose you over a big sort of multinational firm? What I would say to you is this. I've been in the industry 32 years, I think it is, 19 as an advisor, and probably a similar time on this side. The guys at Investsense, the team at Investsense, are as smart as any of the large firms, multinational firms I've worked at, firstly. And secondly, importantly, we still have Bloomberg. We still have FE. We've still got, Bloomberg screen, I think, don't quote me on it, it's something like $60,000 a year per screen. We've got all of the tools that the very large multinational players have got. So whilst you may look at us as a boutique business, please don't walk away from this going, I'll have more options or whatever with a large firm. You won't. So I just want to, I guess, probably make that clear.
Now, so one of the things obviously people need to ensure is that anything that they're investing their clients in is on their approved product list, or now the recommendations. Do managed account providers have research houses sign off on them, or how does that work?
It's a great question, and it's an important question. Fundamentally, no. There'd be very, very few managed account providers like us actually have what we'll call it independent research from a research house, fundamentally because they're competitors of ours. I think that's
okay.
sort of fair to say. Not that that's a major issue, but it's the reality. But I think what is important is that the investments that we use, so the fund managers, the ETFs, they will have independent research from the independent research houses. So, right. And I'll give you an example. There's not a licensee that we've approached because advisors have wanted to use us that we haven't been accepted onto their APL. So there's a massive due diligence process that gets done by the licensee on us, as there should be, firstly. Secondly, the platforms, to be a model manager of an SMA on a platform where you've got trustees, you've got superannuation money being invested, the due diligence the trustees go through is extensive. And obviously we go through that, and you've got to go through that to get on the platform. So there's a lot of due diligence that is done to end up on a licensee's APL.
Yeah, fantastic.
I guess one of the first things that we will do is actually sit down with the advisor and really try to establish what it is that they're currently doing in the portfolios. Because I think the point that you made was good around, you've got different advisors potentially in the firm, potentially doing different things, depending on how big the firm is. I think it's incumbent upon myself and others in Investsense to understand our client, no different to an advisor needs to understand their client.
Yeah.
And then we try to solve for that, okay? So we've got various portfolios. We've got multi-asset portfolios. We've got portfolios that are specifically for self-managed super fund clients. We've got portfolios in the ESG space, the responsible investing space, okay? Mm-hmm. So what we would do basically is sit down, discuss whatever the members' needs are. Fundamentally, our philosophy with investing, probably an important point, is that we come from it with a bit of a value tilt. Now, we're not a dimensional, we're not a deep value investment house, okay? But one of the things that we want to do is make sure that the investors in our portfolios are rewarded for whatever level of risk they're taking, okay? Mm-hmm. And yeah, that leads us to just avoid things that are incredibly expensive, right? So what we would do, our portfolios are what we call multi-asset. So as I mentioned before, it includes direct equities, that's in the Aussie space. It includes managed funds and it includes ETFs. We will make decisions in the portfolios around what are the attractive parts of the market, what haven't gone up so much, and that could be, for instance, at the moment, the UK, so the FTSE 100 is a great area to have some exposure. We access that via an ETF, right? And we're underweight very expensive US stocks, like the mega cap stocks. We're overweight global small caps. And so the construction of the portfolio is very diverse, and it is there to try to take a lot of the bumps and a lot of the risks out of clients' investments, in essence.
Great. So I know one of the complaints that advisors have around some larger managed funds is that they can get so big that they might have an investment philosophy, but the very fact of them making movements in the portfolio are impacting the market. And then therefore, their range is significant, but they don't actually move very much in response to what's happening in the market. That doesn't sound like it's the case with you. You guys actually do make tactical decisions.
Yeah, look. I would say that we're dynamic rather than tactical. I think, look, in my experience, tactical would lean someone to say we have to be making changes, right. Whereas we don't. We are just really always coming back to something we've got a thing called a valuation dashboard, and it basically plots every asset class and sub-asset class, and it looks at the expected return over the next 10 years. And we can take, it's a deep conversation, and I'd actually have someone from the investment team take us through that. Sure. If we had time. But what it leads us to do is really identify where we should be overweight and where we should be underweight. Now, for instance, fixed interest, conservative parts of the portfolio, as we know, interest rates so low whilst going up, you're not really getting a return for your clients if you've got a large amount of money in that part of the portfolio. So we have to have some exposure to growth parts of the market, the equity parts of the market. The question is, how much do you have and where do you put it? I don't want to get too much into the weeds, but to give you an idea, we currently have 50% exposure to the US large cap market, 50% of the weighting that the MSCI, for instance, would have. Right. But we're overweight the UK, we're overweight Japan, we're overweight emerging markets because those markets are relatively cheap and incredibly have less risk associated with them than those expensive US markets. So we're making those dynamic changes to the portfolio without putting someone out of kilter from a compliance point of view. Because let's just assume, as most advisors are aware, you're within a compliance regime. you need to have a client that's 70-30, let's just say, we couldn't put one of your 70-30 clients into something that's, 90-10 or whatever. That would just create too many problems for the advisor. But what we can do is keep a 70-30, but within that conservative, aggressive bucket, we can just do smart things with the capital.
Fantastic.
I would like to maybe just touch on the offer that we've got to the Alliance members, and that is that we have one of the ways I think that we can best demonstrate what we do, how we do it, why working with us makes sense, but in a very practical way, is to actually offer to your members the ability to send us their current portfolios. We will do a detailed analysis of the portfolios, and we will actually put together a comprehensive report. And rather than just send it out, I'll actually have one of the investment team deliver it to you or to the members and explain in detail what we have found with the portfolio. Now, this isn't to say that we're going to look at one of the members' portfolios and say, oh, geez, it's no good, it's terrible, you should just use us. It's not about that at all. It is about just highlighting things that we've identified as potential risks in the portfolios that people should be considering. I know we don't have a lot of time, but let me just talk about a couple that I've done recently. And that is to say, we're in this increasing interest rate environment. Most diversified portfolios have got an element of defensive assets, and a lot of those are bond funds, right? Sovereign debt, etc. I was unfortunately an advisor in 1994 when interest rates in Australia went up, I think about 5 times in 6 months, and clients in those defensive parts of the portfolio lost, double-digit returns, right? They actually lost a lot of capital. Now, we're in that position now. Markets have already, in the fixed interest side, we've already seen rates start to rise. We've already seen capital losses on defensive parts of portfolios. So there's some of the things that may or may not come out of the analysis. I think that it will really demonstrate Investsense's ability to sort of dig deep, understand what people are invested in, and then report back on maybe some things that you may do a little bit better, potentially. You may not need to change anything, but I'd like to sort of throw that out there, I suppose, as an offer to your members,
That's fantastic.
that analysis.
So, Paul, would you not offer that to just anyone?
No. So, but look, we certainly do analysis on portfolios, but they wouldn't. This will be different. This will be far more comprehensive. This will be a lot of detail, and as I say, they'll have one of the portfolio managers will actually take them through the findings.
So that'll be a Zoom meeting with actually one of your analysts to go through it.
Fantastic. 100%. Either a Zoom meeting or a meeting in their office. And there's no obligation. We're not sort of, I mean, it might end up that we say to the member, what you're doing is great. The fact that you enjoy it is terrific. What we do find, though, I have to be frank, is that we find, especially in times like this, there's a lot of anxiety that advisors have got around their portfolios and their clients. Now, again, it's not to say that what people are doing is right or wrong, but when you've got your clients in a portfolio that's been constructed, when you're having to do an ROA or an SOA to make a change to a portfolio and you've got 130 clients, which client do you get to first? There's an element of anxiety. Oh my God, I haven't got to my 40 or 50 clients yet that are at the end of the queue. and fixed interest markets are down by 5%. There's a lot that an advisor is taking on in that instance.
Yeah.
I guess utilising someone like Investsense takes all of that away, because as you know, your listeners will know, you know, the benefit of a managed account is we make a change in the portfolio and that flows through to every investor at the same time, and it just makes sense. It takes all of that pressure away. No ROAs, no SOAs.
Fantastic. So, because in reality, what happens is often firms might say, well, look, for our higher level, might be our platinum clients, then we will do that. We will contact them outside of their review cycle. And inevitably, there's a whole group of clients that it's just not commercially viable for them to do that. So they say, well, we'll rebalance that review time, and they've missed the opportunity. So it's a far better alternative. All of the contact details are in the post from which you found this interview. And by all means, reach out to Paul, have a chat with him. If you are an Evolve Alliance member, without a doubt, you should be taking advantage of that special offer, regardless of whether you're thinking of changing portfolio managers or not. It's a fantastic offer. We thank you for that, Paul. And we look forward to seeing you in another showcase video. And Paul, we'll chat with you soon.
Thank you.
Cheers.
Bye.
Boom.
Is it okay, do you think?